Welcome to Call Wiz, where we break down earnings calls. This one is about underwriting a seller's market buildout.
Sequential operating leverage finally printed. They're marking prices up on new and old SKUs.
And a new delayed draw facility lets them barbell 5-year take or pay with shorter, richer inference and enterprise paper, while interest and capital spend still swamp the equity P&L. CoreWeave, second quarter of 2026.
2.6 billion of revenue, up 24% sequentially.
The beat is real. 300 megawatts of the 500 they added landed in June. So this print is not the run rate of the fleet they're celebrating.
And the visibility number they actually came to sell is 104.2 billion of backlog, plus more than 25 billion of net new after the quarter closed.
More than half of that book is only now in delivery. They say two-thirds by year end.
A quarter of the plus they're waving around is post-print. Visibility is the product.
Adjusted operating income finally did the thing they've been previewing for several quarters. 128 million, 5% margin.
Sequential, yes, from 21 million last quarter. Year over year, it's still down from 200 million.
And that operating line is sitting under 640 million of interest.
Then the spend, 9.4 billion of capex, above their own high end, against 1.5 gigawatts of active power.
Construction in progress jumped to 11.9 billion from 9.6. That's the pile they expect to deploy early next quarter.
Full year investment spend is now 35 to 39 billion.
Against 12.4 to 13.2 billion of revenue.
They're energizing ahead of the P&L. The cash hole widens until those clusters are delivered and billed.
So stop listing. The headline is record revenue, a giant backlog, margins inflected. That's not the call.
The call is whether you'll underwrite a sold-out builder that just proved sequential leverage and is still a leveraged call below the interest line.
You can believe the operating story and still have an equity residual that interest and ramp costs keep underwater. That's the take.
GAAP operating income is still negative. Net loss widened to 626 million.
Operating cash flow and free cash flow were about minus 3 billion and minus 9.4 billion.
GAAP gross margin compressed to 65.9% from 74.2% a year ago.
So the inflection is an adjusted sequential operating line story, not a cash story, not a GAAP story.
They told you the math gets better from here. That slogan only works if you stay above interest.
And they're not shy about the pricing. July, after the quarter, they lifted SKU prices about 25%.
New contracts signed in the quarter came in 5 to 10 points richer on contribution margin. Older generation ASPs are holding at or above year-ago levels.
Near-term capacity remains effectively sold out, their words.
Blackwell and Vera Rubin setting new highs. That 2020 A100 recontracted into 2029 at an attractive price.
Attractive. That's an adjective, not a rate card.
My take, anyway, this is a sold-out market across the whole stack, not just the shiny SKU.
Recontracting is a second life for assets whose asset-level debt is already designed to be repaid.
Effectively sold out. The math gets better from here. Essential cloud for AI. Generational opportunity.
That's a lot of temperature and not a lot of mix.
Connected anyway. Managed inference booked ARR ran from 1 million to more than 100 million in months.
Capacity constrained, they say, with a $250 million exit target. Ampere and Hopper rolling off are the feedstock.
Leftover GPUs go into tokens. That's the migration.
And they closed DDTL 5.5, first publicly syndicated term loan that will finance shorter duration customer paper.
That's the capital markets green light for 2 to 3 year enterprise deals and the inference ramp.
If that facility does what they claim, the 5-year take or pay lease is becoming the debt service layer.
And the margin story is migrating to tokens and shorter enterprise contracts.
Long paper pays the lenders. Short paper and tokens pay the equity if the mix actually shows up.
That's a take. They will not give you the mix.
Samick at JP Morgan asked the recontracting question straight. How big is the pool, and what term and price are customers actually signing as older fleets roll off?
They gave him that A100 anecdote and an adjective: attractive.
Nitin said only a very limited slice of the fleet is up for renewal, and leftover units feed managed inference.
If you buy it, production grade prior gen clusters are scarce. The debt on them is already designed to be repaid.
Every renewal is incremental free cash flow. The original underwriting never needed. Second life on a paid for box.
That's the hidden option in a sold out market.
If you do not, very limited with no megawatts and no dollars makes that option unsizable. A single card story is not a fleet forecast.
They left it unsized on purpose.
Brad at Deutsche Bank went at the allocation problem. How do you give scarce capacity to managed inference versus take or pay?
And what actually drives that 5 to 10 point step up on new deals?
Inference uses bleeding edge GPUs and units rolling off contract. 5.5 is the permission slip for shorter, higher ASP paper.
On the step up, Intrator said quality, TCO, customers monetizing inference, and then called it difficult to deconstruct.
Difficult to deconstruct is the tell.
If you buy the answer, they can now populate a duration curve. Long paper for debt service, short and token for margin, and the credit market will fund the short end.
That's the barbell the thesis needs.
If you do not, they will not split mix versus price versus term. You cannot underwrite a margin step function you cannot deconstruct.
And you cannot know how much inference is stealing from contracted utilization. They declined the split.
Output value has outpaced input increases. That was the other slogan on the supply chain follow-up.
Component costs are up, they're passing them through, and they want you to hear that the customer is paying more than the inputs are costing.
Convenient, if true. Also unproven without the mix.
Irvin, sitting in for Amit at Evercore, brought the local opposition. Moratoriums versus confidence in more than 3 gigawatts next year.
And the 8 gigawatt story by 2030.
Moratoriums change where, not whether. F.2 gigawatts already contracted, about 1.5 of powered land and LOIs.
Call it 6 gigawatts of visibility in the middle of 2026. None of those numbers will be impacted as of today.
As of today is a present tense hedge.
If you buy IT, the 2030 power story is mostly already under option. Risk is energizing and converting letters of intent, not hunting megawatts.
NIMBY is being framed as a siting issue because most of the decade is spoken for.
If you do not, they did not defend a more than 3 gigawatt year-end 2027 print with a site-level schedule.
As of today does not survive a delayed interconnect.
Which is why the connected power story and the connected P&L story are not the same trade.
Every new gigawatt adds debt and ramp cost before contracted cash shows up. Second quarter interest already dwarfs that adjusted operating number.
Third quarter interest is guided 860 to 940 million.
Against the 200 to 260 they guided for adjusted operating income.
5 times, then some.
Operating leverage can be real above the interest line and still a leveraged call below it. That's not a contradiction. That's the capital structure.
They also will not tell you who is inside the backlog. Customer concentration in that 104 billion never came up.
Neither did who signed the extra 25 after the print.
Neither did the actual megawatts or dollars coming off contract. Neither did when free cash flow turns after that full year investment spend.
Neither did the revenue mix of take or pay versus tokens.
4 holes, all load-bearing.
You cannot size recontracting, you cannot size inference stealing utilization, you cannot date the cash flow turn, and you cannot see how concentrated the book is.
Those aren't footnotes, those are the underwriting.
June loaded power is the near-term version of the same problem. If that 300 megawatts landed in June and construction in progress is sitting at that 11.9 billion, the second quarter print is a lagging tape.
The third quarter revenue guide, 3.45 to 3.6 billion, is the first test of whether energized power converts on the timeline they sold.
That's the falsifier I care about. Third quarter adjusted operating income prints below 200 million.
Or margins fail to expand sequentially toward the promised low teens in the fourth, especially if that June cower and that construction pile do not show up inside the guide.
They raised everything. Year-end power, full-year revenue, adjusted operating income, investment spend, exit ARR.
Raising the spend next to raising the P and L is consistent with a seller's market. It's also consistent with a cash hole that does not close this year.
You still on the thesis?
I am. Prices marked up on new and old. Sequential leverage finally on the page. Credit markets now willing to fund the short end of the curve.
That's a real change from the last few quarters of previewing the inflection.
What did not change is that interest and build cost still own the equity residual.
Very limited, difficult to deconstruct, as of today, effectively sold out.
You can hear the sold out market. You cannot underwrite the second life, the mix, or the cash turn from the words they chose.
Watch the third quarter adjusted operating income in that 200 to 260 million range.
And a visible path to low teens in the fourth. Watch whether June's cower and that construction pile convert inside the revenue guide.
Watch inference ARR from more than 100 million toward that 250 million exit target.
And whether 5.5 is actually filling 2 to 3 year enterprise paper, not just sitting as a press release.
Leftover tension is simple. They finally printed the sequential operating inflection they promised in a market that will let them raise price on the whole stack. And the interest bill is still a multiple of that inflection.
Next quarter either converts the June power or it does not. This is not financial advice. Do your own work.
Thanks for listening. See you in the next one.